Good morning, ladies and gentlemen, and welcome to another moment of insights and updates with the Momentum investment team. What a 12-month experience we have just experienced. We've spent a large amount of time in the last 12 months thinking about what refinements, what enhancements can we make to our asset allocation process, our SAA, or in layman's terms, how much are we going to allocate to equities, bonds, cash, and offshore. Key to this process, as you're going to hear, are three main variables. Time frame, so a 4-year fund or a 7-year fund. Risk, how much risk are we willing to take? And finally, what is the investment objective of that portfolio? And as you're going to hear, those three variables are completely intertwined. You can't change one without impacting one of the other two. So if we're looking at a 6-year time horizon fund and we want to achieve a slightly higher investment objective, we need to dial up the risk. But what we've realized in this process is that it's one thing to dial up the risk, but risk needs to be compensated for, or it needs to be rewarded risk. Otherwise, why are we doing this? A final matter that we've also taken this opportunity to weave into our thinking is how do we make our process much easier for members, advisory board members, and intermediaries to explain to members what have they just bought. So if you're looking at a factor 6 portfolio, we know it's a 6-year time horizon. What is the risk and what is the investment objective of that particular portfolio? And after we've heard from Eugene, that should be very clear to all of us. The second topic that we're going to unpack with Mohammed is the investment return on our portfolios for the last 12 months. And from my side, a really big thank you to you, our clients, advisory boards, and intermediaries for your support in the last 12 months. This has been an incredibly difficult time for the investment team, but we reassured clients throughout last year that nothing was broken in the investment team, our process was intact, and our philosophy was intact. And that is now fully vindicated when we look at the 12-month returns up to the end of March. And I'm sure you will feel the same level of gratitude when you hear from Mo shortly after this. Our final presenter this morning is going to be Kudzai, who's going to have a look at how we think about ESG in our investment process: environmental, social, and governance. Now, governance is probably the easiest one to observe, and it's the one that's the most well spoken about in the industry. We're very active holders of all the equities and all the companies that we invest in. We realize and we appreciate we've taken in client money and we've chosen what companies are we going to deploy that capital to. So we need to hold those companies accountable to the right levels of governance in how they behave and how they run their sort of individual businesses. For us, that's a key measure, but there's far more to ESG than just governance. Social is another big one for us to implement into our process. And there you're going to hear a wonderful example of how we've built out student accommodation for the University of Pretoria that's had a massive impact from a social perspective. And we're going to get to hear from students around what it's actually meant to them, while still being a fantastic asset for our clients. And the final element is environmental. And there I can give you several examples, but I'm going to share with you one example, a mall that we built in Witbank. Now, yes, we do build out malls in Johannesburg, Rosebank, Sandton, Cape Town, and Durban, but it's equally rewarding for us to go and build infrastructure assets where we can have a significant impact at a grassroots level in the community. And this mall in Witbank is really such an example. A big social impact in terms of job creation and a multiplier benefit into the local community. But from an environmental perspective, we also considered making it a very green building, rainwater harvesting, and just thinking about how we can make it really clean from an environmental perspective. To us, ESG is far more than a tick box exercise. It's not an afterthought to our process. It's fully integrated into our investment process and our investment philosophy. It's part of our DNA. Thank you, ladies and gentlemen, for your time this morning and for joining us. 2 matters of housekeeping. First of all, if you do have any questions that you'd like to pose to the investment team, please post those in the Q&A section of the Zoom webinar. And secondly, from a CPD perspective, if you're in the Zoom webinar for the entire session, your CPD certificate will be emailed to you at the end of the session. Let me now hand you over to Eugene, who's going to take us through some of the thinking of the refinements and enhancements to our strategic asset allocation process.
Thanks, Wayne, and good day, everybody. As Wayne mentioned, I would like to spend a bit of time today to talk to you about how global risks, structural market changes, economic events, as well as a focus on the future and the world we will retire into have changed the way we as investors should approach investing and retirement planning. We have all come across the famous concept and first principle of investing that says we should invest for the long term. The investment market is riddled with uncertainty, but certain tried and tested principles can help investors boost their chances for long-term success, in whichever way success is defined for you, the client. If your time horizon allows it, a focus on the future with an eye toward long-term investment can increase the likelihood of retiring more comfortably. Staying invested often sounds a whole lot easier than it really is, due to our inherent desire to control and manage our investment outcome. The problem is often that the focus becomes too short-term. Risk is not clearly defined or understood, and we get swayed by our emotions, making it increasingly difficult to remain invested or stick to a strategy or plan that is designed for the long term. So, how do we plan and sculpt that optimal asset allocation for an uncertain future? The key here is that you should have a strategic asset allocation mix that assumes that you don't know what the future is going to hold. So, what is asset allocation and why is it important? Asset allocation is simply an enhanced, disciplined, and more scientific version of the old adage, don't put all your eggs in one basket. It is a way to potentially protect against a major loss should things play out differently relative to expectations or in any one or more asset class. Our research suggests that 70% of the longer-term outcome in terms of return and volatility is driven by the asset allocation decision. Asset allocation is a mix of investment asset classes, ideally based on your personal risk tolerance, time horizon, and goals. The major asset classes are equities, fixed income, and cash alternatives. In addition to the major asset classes, we may also want to consider other asset classes, such as real assets and commodities, with a core focus on responsible investing. The concept and importance of time is represented in the next slide, showing the relationship between time, risk, and reward. The longer the investment horizon, the more certainty you have that a specific risk can pay off positively, and also more certainty around the expected returns you can deliver. Therefore, less variability in the potential outcome. Selecting the right asset allocation therefore depends on several factors, including, number one, your time horizon. That is the number of months or years until your financial goal is the primary factor driving asset allocation. Investors saving up for retirement often invest in riskier assets since they have a long-term horizon, while a parent saving up for a teenager's college education may stick to less risky investments since they have a shorter time horizon. Number two, risk tolerance. The second factor influencing asset allocation is an investor's risk tolerance. In other words, their ability and willingness to lose a larger proportion of their original investment in exchange for potential greater returns. Aggressive investors may be willing to take on higher risk to get better returns, while conservative investors may stick with low-risk investments aimed more at capital preservation. Asset allocation helps investors reduce risk through diversification. Important to understand that diversification relates to risk and not assets. Historically, the returns of equities, bonds, and cash haven't moved in unison. Market conditions that led to one asset class outperforming during a given time frame might cause another to underperform. The result is less volatility for investors on a portfolio level since these movements offset each other. However, in our view, while the strategic asset allocation of a fund may be static, the risk of that strategic asset allocation is anything but static. In periods when risk premia change, the required outcome, especially in the case of a portfolio aiming to deliver positive real returns through time, is unlikely to have moved to any great degree. This implies that under a typical strategic asset allocation approach, the likelihood of delivering the real outcome would shift materially as risk premia change. On this basis, it no longer sounds sensible to describe a fund's risk and return expectations in the context of its strategic asset allocation. In our view, if a change in risk premium on an asset class means that it is significantly more likely to achieve the required return outcome relative to other asset classes, then its weight in the portfolio should change materially, if that means higher certainty to deliver on the client goals. As such, the starting point for portfolio construction should be significantly more dynamic than that in traditional portfolios, and is particularly sensitive to the risk premium embedded in an asset exposure at a particular point in time, as they relate to the client objective. As these risk premium change, the asset allocation should change to better match the client liability. Constructing an optimal client-focused strategic asset allocation is essential to ensure that you reach your financial goals. An investor that isn't taking enough risk might not generate high enough returns to reach their goal, while an investor that's taking on excessive risk may not have enough money when they need to access it. Selecting the right asset allocation helps avoid these issues by ensuring that a portfolio is ideally positioned to reach a goal. As mentioned previously, the asset allocation decision accounts for north of 70% of volatility and returns, which means that your experience will be very consistent with any other diversified investor with the same asset allocation, regardless of the specific underlying investments you choose. In other words, asset allocation matters a lot more than stock picking when it comes to reaching your financial goals. However, for an individual member, the consequences of getting asset allocation wrong on the downside are quite significant, probably more so than most would think. The slide shown shows the impact that a fairly extreme negative market event in terms of returns can have on the final balance of your retirement savings. The assumptions around this table is based on an annual salary increase of 5%, retirement fund savings of 9%, and expected annual growth of 10% in nominal terms. Savings for retirement from the age of 25 to 65. A once-off assumption of a 15% fall in the investment portfolio return is assumed, but at different years to the retirement. The impact on the final value is depicted in the table. Thus, if the minus 15% happens at 35 years to retirement, the impact on the final value is only 6.5%, where it can be as large as minus 21.5% if this occurs 5 years to retirement. In essence, meaning that risk should be proportionately calibrated to the investment horizon. Now, clearly, the impact on members at different points in their career from a large market fall can be quite significant, even for those with a long way to go to retirement. Consequently, managing asset allocation from the point of view of avoiding large negative drawdowns is, in our view, as important as managing purely for long-term returns. In an industry where we have retirement fund members constantly entering and leaving the system, the path dependency of returns is as important as the long-term average return. So how do we effectively solve for our inherent biases, focusing on the relevant and appropriate risks, and what does this retirement fund for the future look like? The key here is to have a clearly defined objective to deliver on and a firm understanding from all parties that includes the client, consultant, and the asset manager, what the expectations are in terms of investment horizon, risk management focus, and resultant return objective. Or in simple terms, the client goal. The goal can simplistically be derived and defined by where a retirement fund member is in his life cycle and journey to retirement. For younger members, the focus, for example, is more about accumulation of capital to ultimately increase the purchasing power of a post-retirement income, whereas for members closer to retirement, the focus is more around preserving the purchasing power of the capital that was built up over the years of pension contribution. The choice of the post-retirement annuity or income solution also plays an important role in defining what purchasing power means, and therefore it is extremely important that the advice processes are directly interlinked to the investment proposition to ultimately deliver on the client goal in the most effective way. An asset strategy or appropriate retirement solution can then be designed, constructed, and managed in a way to deliver on the overall objective. It is therefore important to understand risk in an appropriate and relevant way. The way we deal with risk depends on how it is defined. Risk should be appropriately defined relative to the holistic objective and client goal, as I referred to earlier. Risk tolerance is about knowing where the line is drawn between acceptable and unacceptable outcomes. Risk tolerance should ideally reflect an investor's ability to take risk and not the willingness to tolerate risk. If willingness is lower than ability, huge opportunity costs may be incurred. Willingness to take risk is often wrongfully driven by emotions, peer pressure, and herd behavior, and perhaps a misunderstanding of the requirement to deliver on the objectives. Risk should be commensurate to the outcome required. In a similar way that you would not buy life insurance on a building or take a 30-year term life policy on a 60-year-old person, insurance policies are matched to the nature and the time horizon of the risks. The pension fund investment strategy and solution should be considered likewise in all its complexity, else it will result in unexpected outcomes and surprises. A solution designed to optimally deliver on the client goal is therefore paramount. The investment solution for the future should thus be designed to be aligned to the future goals and objectives of the client. With a focus on increasing purchasing power of a post-retirement income for younger members in a retirement fund, the investment strategy's ability to deliver on real returns, that is, returns in excess of inflation, is very important. In an age of inflation, the challenges associated with the management of pension funds to deliver significant real returns are considerable. For many years, it meant that retirement funds were limited to investing primarily in government securities, listed equity, perhaps some additional debt and fixed interest instruments. Changing market conditions and the need to maintain a high enough rate of return, as well as a core focus on responsible and impact investing, have resulted in pension plan rules that allow investments in most asset classes, including alternative assets and real assets like infrastructure, renewable energy, direct property, private equity, and the likes. These assets are not only beneficial from a diversification and risk management perspective in a holistic, robust, multi-asset solution. It also allows exposure to assets that can deliver on yields and returns that are different to the traditional asset classes. This is required to increase the inflation-beating ability of the solution. At the same time, these assets also allow retirement fund members to invest in assets that support sustainability and to have a real meaningful impact on the economy from a socially responsible perspective. The ongoing coronavirus has amplified the growing calls for resilient and adaptable infrastructure that effectively can operate during moments of crisis. Given this big opportunity, it is imperative that we too look to embark on infrastructure investment programs that strive to provide infrastructure that is sustainable, technologically advanced, and resilient. It is the financially, environmentally, and socially responsible thing to do for the world. Responsible investment practices resonate with our outcomes-based investing philosophy and also resonate with the alignment of our clients' long-term goals to positively influence the world they will retire to. A definite requirement for a retirement solution focused on the future. We believe responsible investment practices and alternative asset classes with real social and environmental impact should be considered as part of a long-term, optimally constructed portfolio. In our ever-changing world, as industries are disintermediated or displaced and lifespans of companies shorten, investors should capitalize on alternative sources of growth by rethinking traditional asset allocation. So, looking at the most important aspects of the retirement fund for the future, it is clear that it is an integrated process of a couple of aspects, with a client goal front and center of the solution. As a result, one size does not always fit all. Cost effectiveness, sustainability, non-traditional asset classes are all key, alongside a disciplined and focused strategic asset allocation strategy. It can at times be frustrating to experience short-term volatility, and the temptation will be to move more of your portfolio into the asset class that is doing the best. This is when it is important to remind yourself that maintaining an asset allocation strategy based on your risk tolerance, time horizon, and goals is an established way to have more success with investing and ultimately deliver on the intended goals. With so many things in life out of our control, it can bring comfort to focus on things that we can control. Asset allocation is one of the few things that can be controlled when it comes to investing, and it just may be one of the most important. Focusing on a disciplined asset allocation strategy rather than the whims of the market is a key component of achieving your personal financial goals. Mohammed is next and will be talking to us about the Factor Series portfolios and how they managed these portfolios during the pandemic.
Thank you, Eugene. Good morning, everyone, and thank you once again for attending today's webinar. During this session, I will provide a very short overview of the market and portfolio returns to 31 March 2021, as well as an update on our current positioning. So I thought what would be useful is just to remind ourselves of the 12-month returns as at 31 March 2020. This particular period was not a pleasant time for most investors, with most of the pain being felt in the first quarter of 2020, where we experienced sharp drawdowns in growth asset classes, i.e. equity and property. These were some of the returns that we just wanted to remind investors and our clients, as painful as it might be, but just as a refresher in terms of what transpired in that first quarter of last year and for the 12 months of 2020. You could see the most of the drawdowns, of the severe drawdowns being felt by property, down close on to 50%, our CAPSWIX down around 25%, and it was only your true safe haven assets like government bonds and gold which posted positive returns during that particular period. What then transpired was a synchronized global monetary policy response, with almost all major central banks aggressively providing liquidity into financial systems, as well as reducing the cost of borrowing, i.e. cutting short-term interest rates close to zero. In addition to these rate cuts, many governments provided huge stimulus packages to businesses and consumers in order to reduce the economic damage. These measures have thus far been tremendously successful, as the fallout has been less severe compared to the initial forecasts. If we then just fast forward to March 2021, and what a difference a year makes, and almost $10 trillion that has been plowed into the system, creating the environment for growth asset classes to outperform. So if we look at these numbers, they're nothing short of astounding. Growth asset classes, equity and property rebounding strongly over this last 12 months. Global equity markets in particular rallied quite strongly on the back of those policy measures, as well as companies being generally more resilient than initially anticipated. Our equity market was also a very strong performer, posting a return in excess of 50%, with resources being the best performing sector. The higher commodity prices not only propelled our equity markets to new highs, but also contributed very meaningfully to our tax coffers and helped our debt metrics. This had a positive knock-on effect on our bond market and currency. You can see that the rand actually strengthened during this 12-month period. So in terms of our portfolios, in terms of the returns, our portfolios were well positioned for recovery in growth asset classes, and we generated credible returns over the 12 months to March 2020. Almost all our portfolios were comfortably ahead of their respective benchmarks, and our portfolios outperformed their respective peer category averages over this 12-month period as well. For the purpose of this particular webinar, we will talk through the performance of the Enhanced 7 portfolio, as this is by far the largest portfolio in terms of assets under management. So you can see the performance over the 12 months, exceptionally pleasing, strong return of 35.5% over the period, with a number of sources contributing to the return over this 12-month period. Firstly, the strategic and tactical asset allocation contributed to the returns. Our strategy diversification in terms of allocation to quality, value, or momentum, as well as strong performance from many of our underlying managers contributing to this 12-month return. Other contributors, is just the deliberate overweight and the local global overweight positions, reducing the offshore exposure during mid-2020, when the currency got to around the 18 to 1850 level in favor of local asset classes. And if we just then focus on the longer period returns, you can see that over 7 and 10-year period, the returns again almost 1% above the strategic asset allocation benchmark, and over a 10-year period, the fund posting returns well above inflation over the 10-year period. So in terms of what contributed to some of these returns, and as I mentioned, in terms of the strategy diversification, so in the first part of the crisis from March to June, our exposure to quality strategies, basically, shares like Procter & Gamble or Naspers on the local stock market, very defensive companies. Those are the shares that did particularly well in the initial stages of the crisis, which protected more capital than the broader market. Then when we got to the end of the second quarter, the beginning of the third quarter, it was shares which exhibited strong momentum, shares like Apple and other tech companies offshore, and on the local market, our resource companies, for example, Implets, those were the types of shares that did particularly well in the period from July up to around October, November. And then towards the tail end of 2020, what we saw on the back of positive developments around the vaccines, etc., we saw value strategies starting to come to the fore as well. So the likes of big US banks like JP Morgan, Goldman Sachs, etc., and on the local side, some of our retailers starting to outperform in a meaningful way and contributing to both absolute and relative returns of our underlying portfolios. It's important to note, that this multi-strategy approach has always been a hallmark of our philosophy and portfolio construction, and has helped navigate the portfolios not only over the last year, but through many market cycles. So in terms of how we're currently positioned, we still remain cautiously optimistic on equity, both global and local, for the following reasons. One, we think, a successful vaccine rollout is undoubtedly positive for global growth. This will ensure that many people return back to work, return back to their offices, return back to some kind of normal behavior that we experienced pre-COVID. Again, a successful vaccine rollout will definitely lead to some sectors rebounding of very depressed levels. Example, real estate, tourism, etc., or your leisure sectors. And again, there's a huge pent-up demand in a number of sectors like travel, leisure, and even, for example, business attire. Many of us will probably need to go and buy, new outfits when we go back to the office. And just in terms, of the pent-up demand, again, there's quite a bit of articles and research going around where there's many popular holiday destinations already fully booked in the northern hemisphere for their summer as well. And then last but not least, we still expect interest rate policy to be very accommodative over the short term, and the possibility of further stimulus measures will support equity markets even further. So in terms of how we are positioned, we overweight global equity and local equity, and within global equity, we overweight small caps. We still think, there's still a bit of value to be unlocked from that particular segment of the market, and we have a slight valuation bias at the moment. We still think that, that small cap and that value segment of the market, there's still a bit of deferred alpha that one could see coming through in the next year or so, as we have more economies and sectors reopening during the course of 2021 and early part of 2022. And we still have a slight underweight to US large cap, specifically the tech sector, because we're finding better value in the small cap and value sectors at the moment. On the local side, within equity, we have a slight overweight exposure to resources, specifically the diversified miners, that would be Anglos and Billiton, and some of the platinum companies where we still have a slight overweight exposure to platinum counters. Still underweight property. That underweight property exposure has been closed out a little bit, but we're still a bit mindful of the property sector going forward. With distributions not being at the same levels where they were pre-COVID level, and some of the fundamentals around the property sector still a bit challenged for now. So we're retaining an underweight property exposure for the time being. Within fixed income, we are overweight nominal bonds, but we have a neutral bond exposure in the portfolios on a look-through basis. But within there, we have a slightly long duration, meaning that if bond yields compress, our bond portfolio will outperform the ALBI over the next 6 to 12 months. And a strong underweight cash position across all the portfolio at the moment. We think cash at the moment is quite an unattractive asset class given the current yields of below 5%, and we think there's better value across most of the other asset classes at the moment. In closing, we think our portfolios are well positioned and suitably diversified across asset classes and strategies. We would like to thank our clients for their loyalty, your patience, and trusting our team to manage your member savings. The returns over the last year has been quite credible. We are exceptionally pleased with the turnaround in the performance that our portfolios have experienced. We are confident that the portfolios will continue to generate real returns over the longer term. Next up, we have Kudzai, who will take us through some of our ESG initiatives.
Thanks, Mo. Good day. As an investment professional, I am a strong advocate of responsible investing, and I believe in doing right by our investors while doing good. And to be honest, there are a couple of things in my own life that really brings this home for me. Why is it that I really take ESG to heart? Well, as a mother, I think a lot about what the future will be like for my kids and how important it is that we carefully consider the world we leave behind for future generations. We have all seen the shift to a more sustainable way of living through various aspects of our lives. Take plant-based eating as an example. It is intriguing how far from the fringes veganism has come, or how we, as the younger generation, need to future-proof our livelihood, considering all the innovation technology has brought about. Also, as my parents enter full-time retirement, I also find myself thinking more practically about the world in which my partner and I will retire into, and how we can future-proof it. So, what is responsible investing? It is an approach to investment that explicitly acknowledges the relevance of environmental, social, and governance factors, and long-term health and stability of the market as a whole. It recognizes that the generation of long-term sustainable returns is dependent on stable, well-functioning, and well-governed social, environmental, and economic systems. Let us unpack this in a little bit more detail. The 3 pillars to ESG, environmental, social, and governance, are integral to our investment process. We also believe that this is the most effective way of generating long-term sustainable returns. In the Factor Series portfolios, we have committed a considerable portion of capital to the Student Accommodation Impact Fund, the African Infrastructure Investment Fund, and the Amandla Renewable Energy Fund, all of which make up the Real Assets program. Real assets are critical to a functioning economy and, most importantly, for our portfolios. Their individual cash flow profiles have limited correlation to public markets and economic conditions. The strategy has a long-term investment theme and aims to deliver inflation plus returns over the full investment cycle. In the investment process, portfolio construction and ongoing monitoring benefit from our strong track record in managing investments in infrastructure, renewable energy, direct property, and commodities. One of the benefits of being part of the Momentum Metropolitan Group with a large balance sheet is that we've got access to the money necessary to make these investments. We can take a long-term view, and because of the reputation and the contacts we have, we can source a good pipeline of deals. When it comes to the well-being of students, student living is of critical importance to us. Every year, many students entering tertiary education struggle to find appropriate accommodation, with the shortage approaching an estimated 300,000 beds annually. ARIS researched the sector and expanded its services into this area, culminating into the RISE Student Living Development, which is a fully furnished student accommodation right around the corner from the University of Pretoria. The property management company put together a project team comprising of young, tech-driven, agile individuals with a good understanding of the student market and the property market. This team brings together property management, finance, and IT, providing a solution that is streamlined and efficient and allows for innovative ideas, such as online leasing. To me, this represents a perfect example of where we can invest to generate a positive, measurable social impact alongside a sustainable financial return. The African Infrastructure Investment Fund is invested in 3 assets, which are 2 toll roads and a renewable energy plant. All 3 investments are operational, mature projects in which we have an equity stake. The toll roads are the N3 route between Gauteng and Durban and the N4 to Mozambique. Both roads are key transport routes in the country, stimulating economic activity well beyond their immediate areas and have substantial CSI activities, focusing on upgrading the education facilities, environmental protection, and road safety for the communities along their routes. The 3rd asset is Umoya, a wind-powered renewable energy plant situated in Hopefield in the West Coast. The plant was the first wind project to receive environmental authorization in South Africa and has a 20-year contract with Eskom to produce 65 megawatts of energy. It has been operational for 7 years and provides clean power to thousands of South African homes. The Amandla Renewable Energy Fund has so far concluded 1 transaction, where the underlying project is a concentrated solar project outside of Uppington, contracted to supply 100 megawatts of energy. The plant is operating steadily and meeting its target energy output to Eskom, as well as its socio-economic and enterprise development goals. Another sizable investment in the Factor Series portfolios is the Direct Property Fund, and here we see deep social effect and multiply effects in the communities around them. Taung Mall in the Northwest Province has led to 68 job opportunities being created, supporting 340 households. Infrastructure development, which brings relative benefits such as improved roads, access to medical care, and transport cost savings. Energy-efficient lighting, achieved by maximizing access to natural light and the utilization of power-saving LED lights. The installation of water and electricity metering devices to reduce wastage. And Emala Mall in Emalahleni created 105 opportunities, supporting 525 households. Green building initiatives by way of water efficiency, metering and monitoring, solar energy, and energy-efficient lighting. In terms of governance, remuneration issues continue to dominate. A breakdown between the relation of executive remuneration and performance measures has been the source of most of our votes against management remuneration. Another ongoing issue is the independence of directors. If directors are not independent enough, all stakeholders will be negatively affected. Many corporate failures have been the result of audit committee members who have not been sufficiently independent. What is important to consider here is that E, S, and G are not always aligned. A fine balance is required between adequate compensation and risk mitigation on the one side, and its ESG risk factors on the other side, and this needs to be assessed on a case-by-case basis. Accordingly, risk governance issues are becoming increasingly important in the risk management process, and as a result, it is also influencing investment decisions with issues such as management concerns, poor operational performance, corruption, and fraud. One particular example is Eskom, who has been plagued with poor corporate governance but remains of key strategic importance to government and the country. And we, as a socially responsible investor, have the responsibility to support this entity. To mitigate and navigate some of these challenges, we have developed a state-owned entities lending framework, which in turn guides our risk management framework. The various entities are divided according to our risk criteria into respective categories of lending appetite. It's informed by corporate governance issues, dependence on government, funding constraints, and ESG issues on an entity's credit rating. To bring further focus to addressing the barriers to sustainable development, as a corporate, Momentum Metropolitan is committed to 6 of the 17 UN Sustainable Development Goals, with a particular focus to ensure healthy lives and promote well-being for all at all ages, ensure inclusive and equitable quality education, and promote lifelong learning opportunities for all, to ensure access to affordable, reliable, sustainable, and modern energy for all, as we are currently making an impact on this in large strides, to promote sustained, inclusive, and sustainable economic growth, full and productive employment, and decent work for all, to build resilient infrastructure, promote inclusive and sustainable industrialization, and foster innovation, to take urgent action to combat climate change and its impacts. While we believe all the SDGs underpin all we do, if we collectively work towards the goals in focus, the impact will be more significant. Linked strongly to this, As the world economy moves to a carbon-free economy, the issue of employees and communities who are dependent on a carbon economy looms large. As most emerging market economies, like our own, are not rich or consist of masses of well-educated populations who can more easily switch to new industries, this transition has to be done in a very gradual and societal sensitive way, so as to not destroy lives and societies. Our commitment to support a just transition on climate change was signed into effect on the 30th of March last year, complementing our recently published climate change investment policy. Here, we give recognition that the social dimension of the transition to a resilient and low-carbon economy is extremely important in our country. As investors, we can make an important contribution as stewards of assets, allocators of capital, and as influential voices in public policy to make sure that the transition produces inclusive and sustainable development. What is really clear for me overall is that responsible investing represents a journey where we have to prioritize generating long-term sustainable growth in our portfolios while doing good wherever we can. Often, the rubber hits the road as we make day-to-day portfolio management decisions, and responsible investing is going to remain a key area of focus for us. It is easy to get our heads stuck in all the details and not fully demonstrate the tangible impact our investments can have on real people and their lives. So, we sent out a crew to one of our student housing projects to meet a few of the people whose lives we are able to touch on a daily basis. We hope you enjoyed the video. After the video, Sonia will wrap up today's session.
Student life can be quite exciting. Living away from home for the first time can be quite scary. But the freedom is exhilarating and there's so much to look forward to. At Momentum Investments, we believe that the best way to give our students their best shot at success is to give them a safe place to stay, where they can work, where they have access to all the amenities that they may need, and where they learn so much more than just about their chosen field of excellence. If our students are our future, then we need to make sure that the future starts off right now. Welcome to Uniton Park, a student facility that has everything a young mind could need and so much more. Within this apartment block, we house 295 students with access to fast, reliable Wi-Fi, within close walking distance to their campus, and with all the other fun stuff that makes student life memorable right on their doorstep. Oh my word, King Moses. So, King Moses, what are you studying?
I am studying dramatic arts. It's my first year.
And how long have you been living here in this facility?
I have been living here for 2 months now.
Okay, and how has it been?
It's been great. It's been amazing. I actually hardly ever go out because I have everything I need here.
And what does that mean to you, to have access to a computer, to have access to Wi-Fi?
It means a lot because it's very convenient for me because sometimes my laptop will be acting up. At least I know I have computers where there's access to Wi-Fi, to the internet, everything. And the study area is actually my favorite. It's so warm in here. So studying in here is very nice. It means a lot.
Great, I love your pants. They're absolutely fabulous.
Thank you so much.
I want a pair. Where can I get them from you?
I actually made these pants yesterday.
What?
I did. I made the pants yesterday. It was a lot, but I love fashion as well. It's one of my passions.
I'd love to actually see the other facilities in the building, what else you have here, what you have access to. And yeah, this is just such a lovely place. I absolutely love it.
There's a lot of beautiful places. Let me show you.
Sure.
So this is the chill area. It's very cool, right? I love it. I just come here to chill with my friend. I was actually here last night just chilling with my friend and catching up.
So, where do you do your laundry?
We have a laundry here.
Really?
Let me show it to you. It's very convenient.
Being in a big big city, you can't always go out. So it's nicer to have places here where you can just go and chill without like spending money and just be with friends. And let me show you one of those places. It's just like up there. So like every unit has like a very cool kitchen. I love cooking, but I'm also a meat lover, so it's nicer to just like come up here and have a braai or just chill with your mates. And like if you're like a fitness person or like me doing drama, I have like body voice and movement and stuff. We have like a very nice gym place where you can do exercise. The breeze here is absolutely amazing.
Vanessa, thank you so much for welcoming me into your home. I mean, as a student, my life wasn't so fabulous. It looks absolutely amazing. How long have you lived here? What are you studying? Tell me.
I've lived here for 2 months now. This is my first year here.
Okay.
Yes, and I'm doing education, a teacher in practice.
Okay.
So it's very nice here compared to living in a campus residence. Living here, I can bring my baby sister here,
Okay.
even for 2 days, I must say. And I also like it here because there's privacy. Our rooms, we don't have communal kitchens or communal bathrooms like other residences. No.
I actually noticed that there's a fridge there, so it means no one's gonna steal your food.
No one, it's only me and my roomie that share the fridge. Now I've grown, I have to look after myself, I have to be disciplined and make sure that I achieve academically.
And I noticed that there's fingerprints and that there's securities and there's cameras, and I mean that's very important to me as a female.
Okay, my safety comes first in everything. So fingerprint scanning is important because not just anyone can come inside the building. Only those who are meant to be here can come in here.
Okay, that's really nice. It looks really nice here, and I like that you have pots, you have the small kitchen, you know, it looks really, really nice.
Yes, it's
and
my
it's nice
second
and clean.
home.
It
My
is home
second
away from
home.
home.
Yeah.
Thank you so much for your time. We appreciate
Welcome.
it.
You're most welcome. Thank you.
I like it here. I love the morning sunrise and the sunset.
At Momentum Investments, we believe in doing well by doing good. Uniten Park is a perfect example of this. These students get their best chance at success. This investment provides diversification opportunities while generating returns. Being a part of the ecosystem that underpins and grows our country means so much more than just delivering profits for our stakeholders. It means being an intrinsic part of the journey to success. Thank you for joining us on this tour, and we look forward to sharing more of our great investment stories with you in the future.
Thank you, Kudzai, and thank you everybody for joining us in today's session of A Moment of Insights and Updates. It is always a great pleasure for us to be able to engage with our investors and be given an opportunity to give you an update on how your portfolios have delivered, and also giving you a greater level of understanding, hopefully, into how our thinking continues to adapt and evolve as this highly dynamic market environment unfolds. The last year has been a difficult year as the world has had to deal and adapt to the challenges of the COVID pandemic. As investment professionals, we've worked exceedingly hard, not to only continue managing your portfolios in a responsible way, but to also take the time and have a hard look at our philosophy and our approach. It is truly critical for us to manage portfolios that have a strong and well-founded approach that is executed in a disciplined way, but also at the same time being sensitive enough to be able to adapt and evolve as the market environment changes. So let's take a little bit of time just to reflect on what we heard this morning, and a couple of key points for me that stands out. Eugene spent some time explaining the importance of a strategic asset allocation as the underpin for prudent portfolio management. The various elements of what goes into strategic asset allocation was unpacked systematically, with insight given to the importance of defining the outcome, understanding the impact of time and appropriate time horizons, and then the centrality of risk management. These three things, which in concert are the components that come together to describe what the opportunity set should be and how you consider it in a strategic asset allocation. He also spent time discussing how the opportunity set or the asset classes are not static, and how there are more and more asset classes coming to the fore and are getting more attention. Infrastructure was an example of an asset class that is becoming more prominent and which has a particular differentiated risk-return profile which can add to an overall portfolio construct. He also touched on the growing importance of responsible investing and how sustainability is actually becoming an element defining the properties of asset classes when coming up with a strategic asset allocation. Eugene then concluded and reminded us what we can control as portfolio managers and consequently where we should focus our energy. So often we are tempted to spend our time and attention on what is generating return and not enough time on the things that we do have control over. Our own behavior, cost control, risk management, all sorts of things that will lead itself to better portfolio management and decision making. Next up, Mohammed reminded us where we were a year ago and what have been the key factors that have impacted global economics and as a consequence, that of markets. The panic that resulted as the world became aware of COVID and the implications thereof, and also what it meant in our portfolios. The market lows of March 2020 will certainly become a market milestone very similar to what we still refer to the 1929 Wall Street market crash, which started the Great Depression, or even the oil crisis in the 1970s, the tech bubble of the 2000s, or more recently in 2008, the global financial crisis. 2020 was dominated by global stimulus packages and unprecedented liquidity, also lockdowns, and then this rush for a vaccine. This has had a positive effect on markets, and as the potential for a vaccine became reality, there was a significant continuance of the upleg of growth returns. Mohammed described how he managed the portfolios through this crisis, with a culmination that now, looking at the portfolio delivery for the early part of 2021, the portfolios have actually achieved strong and credible performance on both absolute as well as relative terms. The session concluded with Mohammed explaining how and why the portfolios are positioned currently, with a slight pro-growth orientation, and described some of the key risk factors, a critical one for us being the global vaccine rollout, that it continues to monitor very closely. Next up was Kudzai, one of our recently promoted portfolio managers and personally one that I'm very proud of. Kudzai has grown into a confident female investment professional in our environment, and I'm so excited to see where she will take her career going forward. Kudzai gave us a fresh perspective on what responsible investing means to her as a portfolio manager. She started by revealing why her responsible investing is so personal and important to her as a daughter and a mother. Sustainability and the world her mom is retiring into, and a strong desire to leave a better world for her daughter one day, are credibly powerful drivers to be able to do the right thing. Kudzai then also described responsible investing and ESG principles, but made it real and practical for us. Integration is the only real way that we can properly address ESG, and she gave real-world examples of what lives in our portfolios. These include student accommodation, renewable energy projects, and also some rural development programs, to name but a few. She also touched on some of the other principles and approaches we have, covering the importance of climate change policies, the principles of a just transition, and the role of governance and active ownership. One of the exciting areas that she touched on was Sustainable Development Goals, that's often referred to as SDGs, and how we as a business have embraced that. As a business, we see this as an ongoing and evolving initiative, and we're very excited about it. So let's just quickly recap what we focus on from a Sustainable Development Goal perspective. At Momentum Investments, we ensure healthy lives and promote well-being for all at all ages. We ensure inclusive and equitable quality education and promote lifelong learning opportunities for all. We promote sustained, inclusive and sustainable economic growth, full and productive employment, and decent work for all. We build resilient infrastructure, we promote inclusive and sustainable industrialization, and we foster innovation. We also take urgent action to combat climate change and its impacts. We ensure access to affordable, reliable, sustainable, and modern energy for all. SDGs are an important and evolving area and provide a tool to align and demonstrate ESG and responsible initiatives and focus. Our video was really aimed at demonstrating to you how real responsible investing and environmental, social, and governance aspects can be, and the progress that we have made on our journey to responsible investing. We are really excited about this progress and how we can demonstrate real value and sustainability with the assets that you, our clients, and our advisors have entrusted us with. Thank you for taking the time this morning and spending it with the team and myself, and I really look forward to seeing you at future moments of insights and update sessions, as well as hopefully seeing you in person.